Well, it started actually in the run-up to the downgrade, of course, with the standoff in Washington. And basically, retail investors took a skeptical attitude and stayed on the sidelines. And we saw trade counts in individual bonds really start to decrease as the standoff grew more contentious, and there was the resolution was not imminent. Once they resolved the issue, shortly thereafter, there was the downgrade, and that really turned people off. And so we saw investors really step to the sidelines at that point. And since then, they've gradually come back to the market, but with a little bit of healthy skepticism, I would say. And it's been a little bit correlated with the equity markets. On the good equity market days, we see trade counts go up a little, and then vice versa.
So what have you been seeing in the credit markets generally?
Well, what's been interesting is that the Treasury market, of course, has continued to rally throughout this whole situation, which has been kind of surprising. Muni markets have essentially followed in lockstep. So yields have really tracked Treasury yields in the muni side. But on the corporate side, because of all the equity market volatility, yields have gone up because corporate spreads have widened considerably. So it's been really a tale of two markets where Treasury yields have gone down, muni yields have gone down, and of course corporate yields have gone up.
So you still like the financial sector over the others. Why is that?
Well, we've seen the most yield pickup in the financials, and so by saying I like them, what I really mean is anyone who sort of has the stomach for a little bit of risk in their portfolio is probably going to see the highest payoff on the financial side. And that again comes from the fact that there's been, as a result of all the volatility in the markets, some of the financial names have been hit pretty hard, and so that translates into higher spreads and as a result higher yields.